Well, stocks giving back gains after a historic turnaround. The Nasdaq coming off its best day since 2001. Investors now weighing the effects of the ongoing trade war, despite President Trump announcing a 90-day pause on reciprocal tariffs. Joining us now, Tom Essaye. He's the Sevens Report founder and president. Tom, thank you so much for being here. Obviously, we have seen a lot of volatility. I wonder how you're viewing both the bond and stock market here. Where are you more bullish right now, stocks or bonds?
Hi, Madison. Thank you very much for having me on. In the near term, I'm more bullish on bonds. I think that yesterday was a pretty important day, and I think that the best way investors should look at yesterday is that it removes sort of the worst case scenario, right? And by worst case scenario, I'm talking about S&P 500 down at 4,000 or close to it, or maybe even below, which were credible cases until we saw the Trump put appear yesterday and that big reversal. It doesn't mean we're out of the woods on stocks, though. There's going to be a lot of concern on growth and a lot of concern on stagflation. That said, I think it does clear the horizon for treasuries, and I would expect yields to generally trend lower in the coming months.
And in terms of the market volatility that we are seeing, how much activity are you seeing kind of on both ends in terms of like short sellers and buyers and where this kind of leaves them at the moment?
Yeah, it's a market that is not for the faint of heart. Let's put it that way, as you guys know. And as far as the shorts and the longs battling, sort of the war has turned in favor of the longs. And by war, I mean not trade war, but sort of the long-term outlook on stocks. Because again, that worst case scenario where the administration drives the economy into a wall appears to be taken off the table at this point. If I'm a short, I am now very nervous, and I'm going to use any declines like we're seeing today to cover those shorts, because at this point, my gains are probably limited, given there is a Trump put, and my upside is not over the longer term, as the economy should recover. It may take a while, but it should recover from all of this.
Tom, you talked yesterday about the Trump put. What do you think? Do you think it was more important related to the equity market or the bond market? And then within the bond market, do you think there was something going on with Treasury selling, other countries dumping Treasuries? What was going on there?
So it was starting to sort of break down, and it just underlies how critically important Treasuries are to every single market. And it's not something that regular investors really pay that much attention to. I mean, Treasury trading and Treasury investing is really more for institutions. And because it's always considered the risk-free asset, people use tons and tons and tons of leverage in that market. And when all of a sudden it begins to misbehave, as it did yesterday, and when I say misbehave, I mean start to trade with significantly more volatility than we're used to, then all of those leverage trades begin to break down. That creates ripples. We have seen things like this twice before in, say, the last 20 years. The first was the financial crisis. The other was the beginnings of COVID. Clearly, people have saw something in the administration they did not like in treasuries, and they pivoted, and that is exactly what they should have done.
So are you concerned, looking ahead, you're not really seeing yields rally that much on the back of all of this? How do you think the direction of travel is going to be with rates? Should it go notably lower on the back of slower growth? Should they back up on the back of inflation? What's the direction of travel from here?
So I think that we will gradually trend lower. So I think that the economy is going to slow in the coming months. I'm not ready to say there's going to be a recession. If anything, over the past couple of years, the U.S. economy has earned the benefit of the doubt. But I do think we are going to see a slowing. I think that sort of this idea that the administration is driving us crazily into some sort of depression has been removed by yesterday's actions. And so I think that now we can look at this sort of in a more calm manner. There is going to be an economic slowing. You can't just sort of pull these levers willy-nilly and expect nothing bad to happen in the economy. But I don't think it's going to be anything that would cause the removal of confidence from treasuries. So I think we gradually drift lower in treasuries. I think that the yield is safe. I think that if you are looking for somewhere to hide, that long-term U.S. treasuries remains, and once again, a good place to do so.
So it sounds like you're not concerned about foreign demand being utilized as a tool in the trade war?
I'm not. I think that 10 years ago, that was a much bigger weapon, but it's just something important for people to realize. these foreign governments hold all these treasuries. Well, if they start just trying to sell them willy-nilly, they're essentially destroying the value of their own holdings too. So I don't think that they are going to willingly sort of see their assets be destroyed just to get at the United States. I think that yesterday's 10-year auction was very important. There was solid demand there. Yeah. And I think that people are looking at this hopefully now as they should. This is a moment in time. It is going to have some repercussions in the short and medium term, but over the longer term, we should get back to business as usual.
All right, a soothing overview for bond investors, Tom. Thank you so much. Really appreciate it.
Thank you.